This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at another accounting standard related to property, plant and equipment. And this one is all about government grants. So we've gone through there and seen PPE and IAS 16. We've gone through as well and looked at borrowing costs and IAS 23. Now we're looking at government grants and IAS 20. So what this one all about essentially? Well, this is whereby you receive money from the government. Okay, that's a government grant. So the government is trying to encourage investment in property, plant and equipment. Could be the government is trying to invest in job creation. So what they will do is they will try and incentivize your business by offering you free cash. Okay, not a lot of governments around the world have a lot of cash at their disposal, but nonetheless they still try to go through there and incentivize businesses to encourage economic growth. Okay, so it is still a relevant accounting standard that you could see in your day-to-day life. So what you've got here, the issue about your government grant is that we need to look at when we're going to go through there and receive it. So what do we think about in terms of the actual recognition? But then we also need to go through there and think about the measurement. Okay, so there's two aspects to it: the recognition, there's the measurement, but we're not too worried for now about any disclosure. Okay, so the key bit there is we're thinking about the debits and the credit. So it's all about whereabout does the credit ultimately go with regard to the measurement. You receive money from the government, you debit your bank, or maybe you're expecting to receive money from the government, so you debit some form of receivable. Okay. However, what do we do with the credit? The credit entry essentially is all about the matching concept. That's what we're thinking about within this accounting standard, matching the income to the benefits that we get. Okay, and the benefits that we get are usually based around recording an expense, whether that is a staff cost or whether that is depreciation. Okay, and then what we have is that those expenses, the staff costs and the depreciation, can be net off against that government grant income on that matching basis. Okay, so first of all, let's go through there and look at the recognition criteria. So the recognition criteria, pretty straightforward, nothing too, if you like, complex about it. You recognize it when you comply with the conditions. So usually there are conditions attached to the grant that you receive from the government. Maybe you will get the grant if you create a particular number of jobs, or maybe you will get a grant if you spend a particular amount of money on an item of property, plant and equipment. As well as complying with the conditions, you should expect to actually receive the grant. So the government hasn't gone through some economic crisis. You've complied with the conditions and the government then turned around and says, sorry, we've got no money in the bank, leaves you a little note, and then that's it. Okay, so the conditions there are that you are going to comply with the criteria of the grant and that you will actually receive it. Again, it's just making sure that we are prudent, that we don't recognize the grant income too early. Okay, so that's when we look at the recognition. The key bit, if you like it, is the measurements. Okay, and what you've got is, as we've said, you get grants with relation to creation of jobs and grants with creation or the purchase of an item of property, plant and equipment. The first grant in terms of your grant for the creation of jobs is usually recognised according, if you like, to your deferred income approach, and that's normally referred to there, isn't it, as your revenue grant. So you will be incurring expenditure as you create the jobs, and then you will then get the grant income, that revenue grant, to match up against that expense that you are incurring. And we're going to use the deferred income approach. So therefore you debit the bank, you will credit the deferred income, and then what you should do there is you should spread that income over the period in which the expenditure is recognized. So if it's that is because you've already created the jobs in the past, then you will go through there and recognize that income immediately in effect. You credit the deferred income and then you release the deferred income immediately. If there are criteria that say that you need to keep those jobs for a particular period of time, so you need to create 40 jobs, they need to still be there in 2 years' time, you will then release that deferred income over the 2 years' time. But from an examinability perspective, I know we shouldn't say this, but it's not as likely to appear as what you see in the next measurement situation, because that's whereby you use the asset to purchase depreciating assets, and that's referred to there as your capital grant. You are getting a grant for capital expenditure. Okay, so again, we're still going to use the deferred income approach. So you debit the bank and credit your deferred income, but what you then go through and do there is that you spread that deferred income over the life and using the same method. Okay, so either straight line or is it the reducing balance? Okay, that's it. Revenue grant and capital grant. So there's nothing much else to it. So let's go through there and look at, is it example number 1 and see how we get on. It's all about grants and depreciable assets. So thinking about your capital grant situation. It says explain how the purchase of property, plant and equipment and the government grant will be dealt with in the financial statements of Tweddle. Okay, so when you're thinking there about the financial statements, I suppose we're thinking there about statements of financial position, statements of profit or loss, and if you like as well, also your statements of cash flows, aren't we? Okay. So what you've got is it says Tweddle bought an item of property, plant and equipment for $10 million. So we will capitalize it and depreciate it. Received a government grant of $2 million. So that $2 million is going to be used to help fund the purchase of PPE. So we have a capital grant, and that capital grant of $2 million will be spread over the same life and using the same method to which we depreciate the asset. What is that? Let's find out and read on. It says the PPE has a useful life, is it there, of 10 years. So presumably straight line. And no residual value. Okay, there we go. There shouldn't be too much else to it. Okay, so what you've got there is, if I think about the property, plant and equipment first, when I think about my property, plant and equipment, the cost that we capitalize there is 10 million, isn't it? Nice and straightforward. The depreciation is it as 1 million, being your 10 million divided by the 10 years, isn't it? That depreciation is an expense, and expenses are recorded in the statement of profit or loss, isn't it? At the end of the first year, your carrying value will be 9 million. That will go there, won't it, in the statement of financial position. Remember, it asked us to explain the financial statements, so SFP and statement of profit or loss. If we wanted to be a little bit more particular and think about the statement of cash flows, then what you've got there, we'll put it in a different color because it's cash flow, so a bit different. You have there 10 million. Is that an outflow on the statement of cash flows? And is that not going to be in your investing activities, isn't it? And then what you have there as well is your depreciation. That is a non-cash expense, isn't it? Which appears in the statement of cash flows. And that's there, isn't it, in your operating activities. If you use the indirect method, isn't it? And don't forget, if it is an expense, you need to go through there, don't we? And add that back to your profit figure. Remember, the expenses reduce the profits. hasn't reduced cash, so you add that figure back, don't we? How easy was that? Nice and simple, wasn't it? Okay. However, you then have a little bit more of a challenge, don't you, when you think about the grant income. Okay. The grant income that you have was it as $2 million. So what you've got there essentially is you start off, don't you, with your deferred income. Is that there is $2 million, isn't it? And then what you have there is that your grant income that you're going to release each year to profit or loss is 0.2 million, isn't it? 2 million divided by 10 years. Okay. So therefore, that grant income appears in your statement of profit or loss, and what you can do there, you can net that off against the 1 million of depreciation, can't we? Okay. What you then need on your SFP is that you will then have your deferred income at the end of the year. Is that there as $1.8 million. That goes through there, doesn't it? And appears on the statement of financial position. Okay. If you want the journal entries, the debits and credits, might that go through there and make things a little bit easier before we come back and look at cash flow. So to help you think about it, if you're looking at the journals, initially you debit your bank with 2 million and credit your deferred income with the same 2 million. Okay. And then what you go through and do is every single year, you then just release that deferred income. So debit the deferred income with the 0.2 million, and then you credit your grant income with the 0.2 million. Okay, there we go. Excellent. Fantastic. So hopefully the debits and the credits might help you a little bit further. Key bit is what you've got there. Don't forget is that we've said the deferred income is on the SFP. That there is a liability, isn't it? And if you wanted, you could potentially go through there and split that out, couldn't we? Again, sometimes maybe going a little bit far, but you could split that out into a non-current amount and a current amount, couldn't we? Okay. The current amount is what you expect to release, is it next year? So is that 0.2 million? If the year-end total liability is 1.8, then the non-current amount is 1.6, isn't it? Because taking the 1.6, the 0.2 gives you, yes, 1.8. Okay, excellent. Again, you only have to do that if you are specifically asked. Personally, I don't think it would be asked. I think you're more likely to go through there and have to think about what the deferred income figure is, okay, in total. Again, just going back to cash flows. What you've got there in terms of your deferred income. This year, you have an inflow, don't we, of cash, which would appear in your statement of cash flows in your investing activities. Okay. And then with regards to, is it your grant income? That's an accounting adjustment, isn't it? So that is your non-cash income. Okay. So again, that will appear in your statement of cash flows. that will appear within your operating activities, provided you are using the indirect method. And again, if you want to go through and really think about it, you need to deduct that amount from your profit figure, because as you have credited profit or loss, you've increased your profits each year for the next 10 years, but you won't have increased your cash, will you? Okay, so therefore, if it's increased profits and not increased cash, we will need to deduct it. Okay, so do be very, very, very careful there. Okay. Although it's not asked for within the question, I just wanted to go through there and think about an alternative method. What we've got is in the standard, there is also a method that allows you to net things off within your capital grant. But not saying it can't be examined, it could be, but a lot of jurisdictions prevent netting off. Okay. So, what we've gone through and done there is we've recorded the asset at 10 and shown the deferred income at 2, isn't it? What we could go through and do there is that you've got there, is it your cost is equal to 10 million. The grant was equal to 2 million. So the net cost is 8 million, isn't it? Okay. If you have a net cost, is it of 8 million, then your depreciation is going to be $0.8 million. So if you then think about it, think about what we've just done there, capitalize the cost. Instead of taking the grant income to, if you like, your deferred income, you have netted it off the cost to give you a net cost of 8, and then depreciated that, haven't we, over 10 years. So you've got a depreciation expense, if you like, a net depreciation of 0.8, which if you then think about what you have done previously in terms of your deferred income approach on your capital grants, we had depreciation of 1 million as an expense and 0.2 million as grant income, which if you net off 1 and 0.2, what do you get? 0.8 million expense. So it doesn't matter whether you use the deferred income approach, whether you use the netting off approach on your capital grants, you end up with the same impact on profit. Okay. I think the big issue that you have, however, is the fact that you're not fairly presenting the financial statements, are you? We're saying there that we have an asset that cost 8. No, it didn't. The asset cost 10. Okay. The deferred income that we have is 2. Now, under the netting off method, you can't even see that there is deferred income that you therefore are going to release over the future periods. Okay, so a lot of jurisdictions prevent the netting off method. However, it is an allowable approach under your government grants and IAS 20 standard. Okay, and I suppose that just briefly ties into the tiny little bit that you have at the bottom of your notes. So the government grant becomes repayable. So maybe the government recall the grant because maybe you've breached some of the conditions, whatever it may be. That is a change in accounting estimate. So don't go back and restate prior year figures. Update this year's figures and the future year figures. Don't change anything you've done into the past. If you have to make the repayment, you will credit your bank. And first of all, you will then debit any remaining deferred income. Okay. If the deferred income balance is not sufficient, because maybe you've got right to the end of those 10 years, or you're 8 or 9 years in, so there's not much deferred income left. But if you have to pay a substantial amount of the grant back, which shouldn't happen, it's very rare that the government recalls the grant, but the standard acknowledges that it could happen, then you credit bank, debit deferred income. There is not enough deferred income there, then any excess payment is treated as an expense and will therefore go through your statements of profit or loss. I just have an awareness of that just in case it crops up somewhere within the exam. I think the key bit is being able to look at capitalizing the asset and then depreciating it and then matching that up to the grant income treatment under your capital grant. Okay, there you go. That's government grants. That's IAS 20. Have a work through, check the questions, see how you get on. Hopefully, it will be to your liking. See you in the next session.